Ladies and gentlemen, thanks a lot for being here with us. I'm Alex Pollock of the R Street Institute, and Desmond Lockman of AEI and I are pleased to welcome you to our conference on Can Puerto Rico Be Saved? And Kruger, whose chair is empty at the moment, is stuck in traffic and on the way, so she will join us when she gets here. We're delighted to welcome her and Brad Setzer back from our panel of earlier this year, in which we had a very substantive discussion, and we're sure we'll have one again. John Miller of Nuveen has joined us, we're happy to say, to bring the essential perspective of the municipal bond market to this problem. Unfortunately, Daniel Hansen is ill today and wanted to be here but can't be. But with all these adjustments, we are ready to go. As everybody knows, we have major legislation relating to the Puerto Rican debt problems pending in the House, coming up for a vote. They're saying tomorrow in the full House. That is H.R. 5278, the Puerto Rico Oversight, Management, and Economic Stability Act. If they hadn't been working so hard on the acronym, they should have called it the Economic Growth Act, because that's, we know, what we have to get for this all to work in the long run. Since our last conference, the looming Puerto Rican debt crisis has loomed even bigger. We've had, of course, a major default on its debt by the Puerto Rican Government Development Bank, and without congressional action, more and bigger defaults are surely in store, perhaps starting with the large payment due on July 1st. So the timing of our renewed discussion seems good, just as Desmond and I figured it would be. It continues to be my view that the Puerto Rican problem involves three fundamental imperatives. First, the creation of an emergency financial control board, and this the pending legislation would do under the name of the Oversight Board. Daniel Hansen told me when we talked yesterday that if you think about the undoubted duration, difficulty, and contentiousness of the work that this Oversight Board is going to have to do, it looks like recruiting the right board may be a formidable as well as an essential task. The second imperative is creating an ordered and equitable process for restructuring and reorganizing unpayable debt. The pending bill also does this. A very important complication here is the $44 billion or so of unfunded pension obligations of the Puerto Rican government. The political force of pension claims, whatever their legal standing in government insolvencies, is, in my view, a credit fact, which is going to be confronted in Puerto Rico as well as in many other places. John undoubtedly has some thoughts on this and the role of pension obligations in municipal credit. Third and most difficult, Puerto Rico needs to develop a real market economy to replace its inefficient, low employment, very low private employment, dependency-creating government-centric economy. In 1941, President Franklin Roosevelt appointed Rexford Tugwell as governor of Puerto Rico, sometimes known as Rex the Red. Tugwell was an academic admirer, believe it or not, of the 1930s Soviet Union, and was an ardent believer in central planning. And he brought his theories to Puerto Rico with him and applied them. Among his creations was a bank designed to be an arm of the state. And this was and is the Government Development Bank of Puerto Rico, which just defaulted on $367 million worth of its bonds. I think it may be fair to say that Puerto Rico needs to escape the ghost of Rex the Red. And I know our expert panelists will have important recommendations on how to move the Puerto Rican economy to a sustainable market-based one. Let me introduce the panel, and I will wait to introduce Anne until she arrives, in which we hope she will make her way through the Washington, D.C. traffic, which isn't as hard a problem as Puerto Rico, after all. If Anne doesn't get here, we're going to start with John Miller, who is co-head of fixed income investments for Nuveen Asset Management, where he's responsible for the municipal bond group. Nuveen is one of the largest and most experienced municipal bond investment managers with more than 100 years in the market. John himself has nearly 20 years of experience with municipal debt, having started at Nuveen as a municipal credit analyst in 1996. Hello, Anne. It was so nice to have you. We're just starting.
I apologize.
We're delighted to have you with us. Can you get in?
That's good.
John
And for here.
I said before you got here how happy we were to have you back, almost back at that point. As I was saying, John himself has nearly 20 years of experience with municipal debt, and he adds to his bond market expertise an active involvement in the related public policy debates. Now that she's here, let me say that Anne Kruger will be our first panelist. Anne is a senior research professor of international economics at the School for Advanced International Studies at Johns Hopkins, a senior fellow at the Stanford Center for International Development and senior fellow of the Hoover Institution. She was previously first deputy managing director of the International Monetary Fund. Last year, Anne co-authored the key study, Puerto Rico, A Way Forward. And today, I guess she will tell us if we are indeed on a way forward. Our third speaker will be Brad Setzer, who is a senior fellow at the Council on Foreign Relations, where he addresses international macroeconomics, sovereign debt restructuring, and financial crises. Previously, Brad was Deputy Assistant Secretary for International Economic Analysis at the U.S. Treasury, where he worked a lot on the Treasury's response to Puerto Rico's debt crisis. The Treasury is now supporting the bill in the Congress. We'll see if Brad agrees with his former colleagues. Our final speaker and co-organizer of this conference will be Desmond Lachlan. Well, I've been busy in the past several months arguing for the idea of the Financial Control Board, otherwise known as the Oversight Board. Desmond rightly kept reminding me of the essential economic growth element of the Puerto Rican complex of problems. As a resident fellow at AEI, Desmond has written extensively on the global economic crisis, including the U.S. housing bust, the U.S. dollar and currency issues, the euro area crises, especially Greece, otherwise known as Europe's Puerto Rico, and the global macroeconomy. Each of our panelists will speak for about 14 or 15 minutes. Then we'll give them a chance to respond to each other or to clarify points. After that, we'll open the floor to your questions, and we will adjourn promptly at noon. Anne, great to have you back.
Thank you. Am I on? And apologies for being late. It's not my fault. It's not the Metro. It is the Metro's fault in the sense that the route I came in yesterday that should have taken a half an hour took an hour, so I allowed an hour and 15 minutes, and it took an hour and a half. So even with the Metro out, you can't predict. Anyway, the title of this session is Can Puerto Rico Be Saved? My answer would be yes, it can be saved. Will it be saved? Maybe. It's not the same thing. Of course it can. Let me start by just sort of saying I think it should be the jewel of the Caribbean. I said this before, but I will say it every time, because Puerto Rico is a beautiful island. It has English as a language along with Spanish. It, in addition, has American law and order, and the U.S. dollar as a currency. And all of those things should make a big difference in the positive sense. Every one of them is an advantage. It's a comparative advantage over every other Caribbean island by far, and it should be made a use of. Unfortunately, that is not at the moment happening. It has a long, sad history, and if I have time, I go into some of it, but I won't. It is U.S. territory, and that is important because it basically means that whatever Congress wants to do, it can do. It is a commonwealth, and it has its own constitution, but so far as I know, there's been no test of whether the Constitution can do something that goes counter to the U.S. laws or the U.S. Congress. That is just not something that right now is something that is a big question, so I won't go into it. Anyway, until the 1970s, there was almost total neglect of Puerto Rico. After the 1930s, when President Roosevelt gave Rex Tugwell, who was an avowed socialist, purview over the territory, whereupon...
I mentioned him in my opening remarks as
Right.
well, so we're tracking.
Okay. But in any event, opened about 150 what we would call in developing countries state economic enterprises at that time, many of whom, in fact, most of whom are still in existence. Except for that, not much was done till the 1970s, and Puerto Rico was clearly in the doldrums as other Caribbean islands were making, and other countries were making some progress. And the response was to pass a law which basically said that Puerto Rico would have triple tax exemption for companies that located there, which of course gave a huge advantage to capital-intensive countries, which are exactly the opposite of what Puerto Rico's comparative advantage was. Many of them, however, took advantage of it, bringing in mostly high-skilled and highly educated American scientists and engineers, using very little Puerto Rican labor, making good profits, and of course then shipping those profits back to the shareholders as you would expect. But in any event, the only other thing I want to mention from that part of history is, first off, a mini boom ensued for the next 15 or so years. But in the 1980s, early, unnoticed at the time, when the U.S. bankruptcy law was amended, as it seems to have been periodically during its long and arduous and tortured history, somehow or other, what had been in the bankruptcy code applying to states and territories, i.e. including Puerto Rico, in Chapter 9 of the Bankruptcy Code, it was explicitly excluded. So Puerto Rico is not subject to that, and that's a little bit important for what's coming later. But at any event, let me continue quickly because I am conscious of time. After the good years, in 1996, the U.S. Congress, in its wisdom, passed a law gradually phasing out the tax exemption over the next 10 years. Puerto Rico did relatively poorly over that period of time, but starting about 10 years, or now 12 years ago, it did even worse. Its per capita income is no higher now than it was then. The territory responded, and successive governors of both parties did so, and legislators, by assuming it was a recession and using what they regarded as traditional Keynesian remedies, i.e. Spending more than their income. Now, they cannot borrow. They're fixed in the dollar, so there's no way they can change the exchange rate, and they cannot use monetary policy. So all that was left, and what they did, was fiscal policy. And they ran deficits. At first, they ran them quite consciously, but after a certain period of time, and I'd have to check exactly which year, they began announcing that they were running balanced budgets. I believe that the successive legislatures and governors believed that they were passing balanced budgets, but revenues always fell short, expenditures always were above the projected level, the result of which was accumulated debt, which was the only thing they could do. Things have finally come to a head because they can no longer borrow, they can't print money, and indeed they cannot pay their bills, including their debt, in such a way that come July 1st, if nothing is done, Puerto Rico will technically be bankrupt. Presumably its assets will be tied up in the courts. As that happens, and with the territory not having money, it is very likely that essential services even will have to be suspended, including perhaps even such things as fire, police, and what have you. If they don't have the financing, it's very serious. And when the things are tied up in court, as they may well be, because there's no legal framework, if you like, for handing this out in a more friendly way on both sides, it's a problem. But let me continue with that, and I'm sure we'll be coming back to the debt quite a bit. The island is in terrible economic shape as a result of all this. Its GDP is about $72 billion, although their statistics are not good. And so any number I use has a little bit of a wide margin around it. The debt is about $72 billion to other dollar-denominated things overseas, but it's also about $42 billion in the next several years owed to the pensioners and retirement funds on the island. If you add those two together, debt is more than 150% of GDP, and it averages something over a 6% interest rate, and if you multiply 1.5 times 6, you get 9. 9% of GDP on debt service, not mentioning rollover, does not seem feasible under even the best of circumstances, and this is not the best of circumstances. That in itself, of course, puts a further damper on economic activity because there's uncertainty as to what will happen. But let me continue. There is outmigration to the United States and there has been in the mainland, and there has been for some time. That outmigration has accelerated in recent years. It is best guessed that last year, calendar 2015, outmigration was approximately 2% of the labor force. Now, that number in itself should startle everybody because any attempts to raise taxes is most likely going to make that worse, although there are some things they could do that would be both business-friendly and make the tax system more efficient, but they would take time to take hold, and they will not address, in the short run, the present crisis, but I'll come back to that. It is estimated that today there are about between 3.4 and 3.5 million Puerto Ricans in Puerto Rico, and there are about more than that, maybe 3.6, 3.7 or more, Puerto Rican-born folks on the mainland. They've already lost more than half their population. This was going on slowly before, but it has accelerated, and that's a problem. The labor force participation ratio, and we think ours is low at 63% of the labor force, and they have a younger the population, and they have a younger labor force than we do, so it should be higher, is about 39%. 39 is lower than any number I've ever heard of in any developing country I know anything about, or any I've even looked at, I suppose. There are reasons for this. A major one is that, and we just got the calculations for a family of three. A family of three, if the man or the woman, either one, works at the minimum wage, but just one wage earner, and they pay taxes as they're supposed to, their take-home pay would be about $1,100 a month. If instead they go on welfare, get food stamps, they get a housing subsidy, they get something on power and electricity and other things, they'd get the equivalent of about $1,700 a month. How hard would you work to lose $600 a month if you had to pay for the privilege? Not everybody has only one wage earner, of course, and not everybody is at the minimum wage, but the minimum wage, they're about, it's estimated between 80 and 90% of the labor force are at or within $1 of the minimum wage. So that's not a bad estimate. So welfare versus work, welfare wins. There is an informal sector. I could not find anywhere a reliable estimate or even a semi-reliable estimate of the size of the informal sector. Everybody agrees with that in every country. I mean, how do you find out who's working illicitly? They don't want to tell you because, of course, there are reasons not to. But the informed guesses, and they were guesses that I heard, were about 25% of the 25% of the employees are in the informal labor force. Some people told us stories of hiring a maid 1 or 2 days a week who would not go to full-time because she wanted 2 or 3 days a week to get Social Security or something like this. So there is some of that, which means that even those in the labor force are not necessarily there full-time. They, as I said, can't devalue or print money or borrow, so they're in trouble big time, and I could go on with the list, but I don't have time. So let me move on to what they need. They obviously need several things, and there are three. And I'm in no particular order, except that I think the certainty about the debt would have to come first before much else will happen. But except for that, it's not more important than the others. The three things are, they have to change some of their domestic policies, which are distinctly anti-growth, anti-business, and look very Latin America of the 1960s to me. To give you a shorthand phrase for the whole thing. I'll come back to that. They secondly need support from the U.S., and I do not mean money. I mean, on the one hand, changing some of the laws that treat Puerto Rico worse than they treat U.S. states, of which the major one is the Affordable Care Act, where they are required to provide the same things for their citizens as the other states of the United States do, but they get half the money back, block grant, that Mississippi would get if it had the same numbers, okay? And that is $2 billion per year, and their block grant ends in 2017. Without that, their hole fiscally is even deeper. by about 3 or 4% of GDP, which is a huge number in a country that can't raise taxes, or in a territory that can't raise taxes very much. There are other things the U.S. could do which would help a lot. Among them, may raise the minimum wage and so on. I'll come back to that. And thirdly, there are things that have to be done with regard to the debt. So those are my three categories. Anti-growth policies. There are a lot of them. They have been in the, they have a development agency, so-called. If you want to go and start a business there or move a business there, what you do is you don't go and look at the tax rates because everybody knows they're not relevant. What's relevant is your negotiation with a guy there, and that guy negotiates a commitment on taxes for 10 to 15 years or whatever, and very often then will come in to renew it. The legal tax rate, the statutory tax rate for companies in Puerto Rico with the usual kinds of qualifications and so on is over 30%. Actual collections are 4%, which is even worse than the U.S. mainland, and ours are mostly legal with exemptions. But theirs are mostly things that are negotiated ahead of time. And when I did inquire of the agency, had they done cost-benefit analysis as to what these tax losses were worth in terms of other things, they didn't seem to know what I was talking about. I guess it was never done, and I think that's probably right. But that's only one thing. There are lots and lots more. Their statistics, I think I already mentioned, are a shambles. So much so that at one point when we were getting our numbers, we went to whomever we were told had the best numbers on things. And at some point, one of the people we talked to seemed very good, and is, I think, very good, called us and said, where did you get such and such a number? To which the answer was, from you. Meaning, he didn't know where he got the number from. And there are things like that all over the place. Their numbers are late, which has had Congress thinking that they're trying to hide something. I don't think so. We were hired in part to do the study because they felt the politicians in both parties and the authorities did not feel they knew what was going on. Our job was really almost fact-finding with, of course, some analysis of the facts once we got them. I could go on. There are many more things they need to do. They have the minimum wage, and I'll come back to on the U.S. side. It is applicable to Puerto Rico. And the Puerto Rican legislature has legislated that everybody should be entitled to a 13-month bonus. So the minimum wage in Puerto Rico is above that in the U.S. Everybody is required by statute to have 30 days vacation in the public sector and 18 days sick leave, which they can turn into vacation time if they don't use it as sick leave. These things make them more expensive, especially at the unskilled labor end, than in the mainland. Okay, I could go on and on and on. The earned income tax credit, they are not eligible for. Puerto Ricans who do pay Social Security are eligible for that. The Jones Act makes shipping to and from them much higher than cost than it would be to, say, the Dominican Republic, which is right next door. The best estimate is that oil costs them 40% more. And 40% more on oil means that their cost of producing electricity, if they had the same efficiency otherwise in oil-powered plants, and almost everything in the Caribbean is oil, would be, of course, that much higher because their major input is that much higher. I could go on with many more things. The last one I'll mention just briefly now and come back to if I have time is, of course, the bankruptcy, which they are not eligible for, which is a problem. Okay. Anti-growth policies I covered quickly. The U.S. The thing that hurts them most, in my view, and I think the view of many economists, is that they are subject to U.S. minimum wages. Now, the problems with that are twofold. First off, their per capita income is much lower. Their per capita income is estimated to be half that of Mississippi, which is our poorest state. Okay? Now, paying the same minimum wage bites more, the lower the average should be. So there are lots of people who are probably not very skilled, and they can't even enter and work for a few years at something while they acquire skills. And where does that hurt most? The tourist industry, which should be one of their jewels. And it hurts the tourist industry for families and larger groups and stuff, the mass market, more than the upscale. And with that, there are all kinds of other laws. You may not hire anybody to work more than 8 hours in any 24-hour period, so you can't take the night shift at the restaurant one day and the luncheon shift the next. On top of that, you're competing with the Dominican Republic and Mexico, and I'll take Mexico as a better example, where the best reasonable estimate of a comparable minimum wage, and they've got several for categories, which makes it hard, is about $2 an hour. $2 versus $7.25 beaches in Cancun are quite fine. Who's going to go to Puerto Rico? The number of tourist beds is not more than it was in 1970, despite the boom in tourism in the rest of the Caribbean and Florida. No more tourist beds over 46 years. Is that believable? Almost not, with everything else going on. So with all of those things on the U.S. side and more, there's a lot of room for the U.S. to find things, and of course the current legislation before Congress would do some of them, including, in my judgment, importantly, if it's passed, have some kind of an entry wage into the labor force, so you could have 2 or 3 year internships, or call them what you will, apprenticeships, so that people could get some skills and move to higher wages jobs. Most people in the U.S. do not start at their wage they expect to get by the time they're 35. They expect an increase in wages as they learn, and so on and so forth. And yet in Puerto Rico, they can't do that. Finally, the control board, I think, is probably something that they know they have to have. I think the real questions will be, what are its powers? Will it have enough information to do its job, and will it have the authority to do it in time? And on both of those counts, I have some misgivings as to the way it's now structured, but I won't go into that because that's further along the line. They have to do things on economic growth. They have to do things on their own. And I think everything right now in Puerto Rico is basically on hold because they're so worried about their short-term finances, and the message that they've got to restore growth and get rid of some of these growth-destroying laws, which would take a bit of time even if they get going, does not seem to have caught attention as it, in my judgment, should. There's nothing you can do on debt restructuring or anything else that will make a difference in the longer run unless growth is somehow restored, because they can't borrow again and they can't otherwise make it. And I think I have exhausted my time.
Thank you, Ann. John.
Thank you.
Got to push your button there on
Sure.
your thing. You on?
Well, thank you very much for having me. So I'm co-head of fixed income at Nuveen Asset Management. We manage approximately $117 billion in municipals as of the end of the last month. I personally oversee the group. I also have a focus in high yield municipals, where I manage about $20 billion in high yield municipals. So what I would like to do is relate Puerto Rico and the last several years of developments in terms of the economy and finances and the performance of the municipal bonds outstanding from Puerto Rico to the broader market. Talk a little bit about these contagion risk warnings. Touch on the pending legislation, which may start to be voted in this week, and what we think impact that would have on both Puerto Rican bonds and the broader municipal bond market, and also how the municipal bond market could be of a benefit to could provide a benefit to Puerto Rico specifically longer term. First of all, I think that putting some things into context, while very large and very complicated, the Puerto Rican debt outstanding does represent less than 2% of the total municipal market, and really started to exhibit material weakness back in 2013. Of course, 2013, the municipal bond market was under some pressure from a variety of different sources, Puerto Rico included, Detroit's bankruptcy included, and also the Fed change in policy creating the taper tantrum and a significant interest rate sell-off. All were happening at the same time in the second half of 2013. So while Puerto Rican bonds were starting to get weaker in 2013, they were much more in line with the broader market. So the differentiation, which really has started to occur, really started at the beginning of 2014. As the municipal bond market as a whole started a recovery and really a historic rally, actually, while Puerto Rican bonds continued to tailspin lower based on fundamental developments. The Puerto Rican bonds have actually underperformed the general municipal market every single quarter since year-end 2013 and year-to-date 2016, including year-to-date 2016. We've gone right through the high-yield territory, right into distressed territory at this point in time. But again, hasn't stopped a broader municipal bond market rally and hasn't stopped increasing demand for municipal bonds, in spite of the fact that there's been growing uncertainty, growing underperformance, and growing expectations of debt restructuring in Puerto Rico. It's really a matter of how it gets done as opposed to whether or not it's going to occur. So this slide here actually shows municipals in the context of other asset classes around the world in the financial markets. And both investment grade municipals and high yield municipals have actually had the lowest standard deviation of total returns, so the lowest volatility of any asset class by far since 2013. And Puerto Rico is included in these figures. So again, just trying to put things into context, only 3% standard deviation of total returns for investment grade municipals since 2013, and about 3.75% standard deviation of total returns since year end 2013. That's lower than global sovereigns. That's lower than U.S. Treasuries in the 10-year to 20-year part of the yield curve. Obviously, much lower than the S&P 500. So there's been very low volatility and strong returns. These are broad-based municipal indices that include everything. So as a result of strong total returns with low volatility, the Sharpe ratios, so risk-adjusted returns for the muni market, are the highest of any of these asset classes before even adjusting for the fact that municipals are also tax exempt and give individual investors a big tax advantage. So on a risk-adjusted basis, on a tax-adjusted basis, even with Puerto Rico embedded into these indices have performed incredibly well. So these are one of the reasons why I don't think that the muni market is necessarily going to have this big negative knee-jerk reaction to a restructuring initiative, because as I'll talk about in a second, people know these restructuring initiatives are coming. They may not know exactly how they're going to be implemented, as that's still a lot of those details still have to be sorted out. But pricing of munis, pricing of Puerto Rico specific munis, demand, are all incorporating what we're talking about here. So what I'll get to in a second is I think warnings about contagion are I don't think very compelling. The specifically getting into demand for municipal bonds as a whole and how that has evolved. As I mentioned, 2013 had a significant softening of demand. What these charts show actually are using Lipper data and adding all muni bond funds in all the Lipper peer groups that are tax-free muni bond funds, and looking at their cumulative fund flows over the course of each of these calendar years, 2013, 14, 15, and year-to-date 2016. And again, 2013, while Puerto Rico started to get downgraded in 2013, it was certainly not in the distressed category at that time, and the weakness of Puerto Rican bonds was really embedded in everything else that was going on in the municipal bond market that was creating pressure. So again, including Fed policy, interest rate volatility was higher back in 2013, and Detroit was in bankruptcy in 2013, and that was creating the $58 billion in outflows that you see in the 2013 chart. But literally ever since then, there's been a recovery in demand. $28 billion of inflows in 2014, $15 billion in inflows in 2015. And then actually the year-to-date pace in 2016 of $22 billion in inflows through April has been very strong, and it's also been very consistent. In fact, the last 35 weeks in a row has shown consistent inflows, averaging about $1 billion per week for 35 weeks in a row. And then if you think about the last 35 weeks, there have been a lot of negative headlines about Puerto Rico in the last 35 weeks, but that has not prevented $1 billion a week going into the market. Of course, this is just one source of demand, but it tends to correlate to other sources of demand. So in other words, individuals buy munis through mutual funds, which is what is shown here. We also know that, of course, they buy muni bonds directly. They buy muni bonds in their separately managed accounts, ETFs, closed-end funds, all of which are trading better. So this is in line with those other components of the marketplace that are all basically showing the same thing. But it's easy to demonstrate just by grabbing these Lipper peer groups and seeing what the fund flows look like. The pricing differentiation, Puerto Rico bonds versus other bonds, has been dramatic. First of all, at the end of 2013, high quality municipal bonds with a 5% coupon, long on the yield curve, so say in 30-year maturities, were roughly speaking around par, fives at par to yield 5%. Those bonds, broadly speaking, are now at about 2.5% in yield. So their yield has dropped by half. Of course, when yields drop, prices go up. And that actually takes high-quality municipal bond prices with 5% coupons around 120 cents on the dollar. Of course, it'll depend on call features and so forth. But generally speaking, the bonds that were priced at par at the end of 2013 are priced at 120 today. That's in contrast to, in 2013, Puerto Rican bonds were at least in the mid to upper 90s, close to par at that time, and now have a general trading range anywhere between 20 cents for the least well-secured bonds to a maximum of 65 cents for the Puerto Rico GO 8s of 2035 that were issued in 2014. So 20 cents to 65 cents, the general range, I'm excluding insurance here, uninsured Puerto Rico bonds, 20 to 65 cents. That's down from par at the end of 2013 versus high-quality munis with a 5% coupon. They've gone from par to 120. So that is a stunning differentiation in performance, and shows that, again, the market knows what's happening here. And when it comes to the PROMESA legislation, proposed legislation, specifically, that's actually not hurting the Puerto Rico market either. In fact, it's overall, if you add some of the big buckets together, they're either unchanged or higher. I think specifically, the legislation has actually helped COFINA bonds move higher in the secondary market. GOs are roughly unchanged, as the probability of this legislation getting passed has been moving higher and higher over the last 2 months. COFINA bonds have moved higher. GO bonds are roughly unchanged. PREPA and PRASA bonds are also roughly unchanged to a little bit higher. So the legislation is not hurting Puerto Rico bonds. And of course, it's certainly not hurting the municipal bond market, which continues to be increasingly strong and facing increasing demand, actually, for municipal bonds generally. So I personally think it's helping both, because it can create an environment of stability as opposed to wondering what the next lawsuit is going to be on the next particular indenture. Those would be stayed, at least temporarily, while a control board figures out how much debt they can pay and figures out the prioritization and provides for a much more orderly and process with better, cleaner, and clearer information. As I mentioned, the investors are just to pile on this point a little bit more. I'm talking about investors anticipating a Puerto Rico restructuring, but still liking their investments in municipal bonds. And this is, first of all, these are another way of looking at cash flows and another way of looking at demand for muni bond funds. And again, since 2013. This is the high yield peer group specifically, so these are more credit risk or credit sensitive municipal bonds. Since the end of 2013, investors have added 15.1 billion in inflows into high yield muni bond funds, which have less than 5% exposure to Puerto Rico. That's about 8% growth in assets under management for that category. But simultaneously, they've pulled 1.8 billion out of funds that have more than 5% Puerto Rico in those funds. That's 45% loss of assets under management for those funds. So investors are clearly looking at what fund exposures are to Puerto Rico and shifting. And they have been shifting for 2.5 years now. So again, are investors aware of what's happening and prepared for some kind of change in ultimate recovery rates and coupons? Yeah, I would say they definitely are. Investment managers have responded as well, being aware of this and seeing this and knowing this. Morningstar data show that as of fourth quarter of 2013, about 75% of all muni bond funds had some exposure to Puerto Rico. By the end of last year, that was down to 50%. Less than 50% of all muni bond funds had any exposure to Puerto Rico. Similarly, Citigroup just came out with a study which has sort of similar results, which is to say that in January of 2014, 974 mutual funds had some Puerto Rico in those mutual funds, and that grand total was $38 billion. And by the end of last year, that was down to 122 mutual funds with a total invested exposure of $30 billion. So down $8 billion in exposure, and also down over 850 funds gone from having some Puerto Rico exposure to zero. So again, another significant shift. While hedge funds have ramped up their exposure, particularly in GOs and particularly in the 8s of 2035. So again, I think all of these statistics show that the risk of contagion is not going to come from outflows in our view. Because again, portfolio managers have shifted their exposures, individual investors have also shifted their exposures significantly. And that's been going on for 2.5 years, and the market has continued to rally. Importantly, the PROMESA legislation specifically has been a stabilizing factor on Puerto Rico bonds broadly, and has not impeded the broader municipal market either. Down to 1 to 2 minutes. Okay, so quick comment on Puerto Rico means that Illinois is next, and that is a couple reasons why we object to that. We've heard that statement time and time again over the last couple months, and disagree with it both on legal grounds, Illinois obviously being a state, Puerto Rico being a territory, subject to the control of Congress if they choose to exercise that control, but also just purely financially. And that being Illinois, if you take Illinois' debt and its unfunded pension liability and compare that to its GDP, you get 19.5%. So that is the highest of the 50 states. 19.5%, being too high, needs to be addressed. Or debt and unfunded pensions to personal income, 38.8%. So those are tough. Those are tough numbers, and work needs to be done on those numbers. But compare that to Puerto Rico, debt to and unfunded pension to GDP, about 96%, or debt and unfunded pension to personal income, 260%. So that feels more like the point of no return. Also, Illinois has a personal income tax rate of 3.75%, the result of a phase out of a 5% rate. Take that back up to a 5%, and doesn't necessarily solve the entire problem, but you certainly made a ton of progress. 5.75% personal income tax rate in Illinois, if that were to be implemented, that would also be, go a long way towards improving and stabilizing the situation in Illinois. So Illinois is not about to come to Washington, D.C. to ask for some kind of restructuring assistance, regardless of how Puerto Rico works out. And one quick comment on the GO. The GO is a narrow focus of quote unquote contagion risk, but every major bucket of indenture in Puerto Rico has a corollary in the U.S. muni market. Dedicated tax revenue bonds, as represented by COFINA, are almost as big a presence in the municipal bond market as GOs are. About 10% of a broad-based index are dedicated tax. About 11% of a broad-based index are GOs. So, and high single digits for water and sewer bonds, as similar to PRASA. Mid-single digits would be electric bonds, similar to PREPA. So it's not just that the GO has a corollary in the GO muni market, is every major bucket of debt has a corollary in the United States. So I'll leave it there in the interest of time.
Thanks, John. Brad, nice to have you back with us.
It's great to be back here. I thought I would organize my remarks around three broad points. The first is that the PROMESA legislation is a necessary but not sufficient condition for a long-term solution to Puerto Rico. The second broad focus is that Puerto Rico's debts, and I'm going to agree very much with John, are by almost any measure unsustainable. They are unsustainable if you think of it from a classic sovereign point of view, and they're unsustainable if you think of it from a classic municipal point of view. And then third, I want to offer some general observations about the challenge that the complexity of Puerto Rico's debt poses for the future restructuring, given that the logical conclusion of unsustainable debt is that that debt needs to be reduced. So first, PROMESA, necessary. Why? It is the only viable path for Puerto Rico to reestablish budget credibility, and it is the only viable path to provide the necessary legal tools to carry out the debt restructuring. Budget credibility is obviously a problem. I would emphasize, as Ann did, that revenues have been consistently overestimated. In addition, there are certain pools of expenditure that have been kept off budget. A lot of the debt service is kept off budget. And then there's been a series of cash flow gymnastics that have allowed revenues to be pulled forward at the expense of future fiscal stability. Many of the tax agreements that Ann mentioned have been at various times used as a funding source because companies or the government will approach a company and say that if you'll pull forward some of your future payments, we'll reduce those payments, which is a form of funding, but it raids your future revenue. So broadly speaking, Puerto Rico has a very serious problem with budget credibility, and its budget institutions need to be strengthened. Future budgets need to be based on a credible, independent estimate of tax revenue, which provides a true estimate of the amount of spending that is possible. Second, necessary restructuring tools. It is critical that Puerto Rico's debts be organized and allowed to vote on restructuring terms. The Title VI provision of PROMESA, the so-called collective action clause, allows such an organized process whereby debt of basically the similar quality, so same seniority position, same security pledge, can vote together on a set of restructuring terms. In an ideal world, that would produce be sufficient and produce a agreed path to restructuring. But given the very diverse set of debts, I think it is very critical that that PROMESA includes Title III, which provides for a more formal court-supervised restructuring process that makes sure that no one small category of debt can play a game of trying to exempt itself from any form of concession. These tools are vital because debt restructuring is a part of the solution. But they're not. Debt restructuring and improved budget credibility are in and of themselves insufficient. I agree with Ann on many of her points about how there is scope for Puerto Rico to take action on its own to strengthen its growth. But I do want to reiterate that a couple of shifts in federal policy will, in my judgment, ultimately be necessary. Ann alluded to the fact that Puerto Rico receives far less in Medicaid funding than it would if it were a state, and that this causes a very significant, or will cause very significant fiscal distress. It's in the range of a couple of billion, the gap, and there is no viable Puerto Rican budget for 2020 that pays debt service to anyone that does not have unless there is a shift in the Medicaid funding ratios. So that is not necessarily a message that those who cluster around the American Enterprise Institute necessarily want to hear, but it is untenable for our poorest Americans to not benefit from the federal program that funds health care to poor Americans. The second point, which I think will ultimately be necessary, is a reform to the Earned Income Tax Credit, which Ann also alluded to. Low-wage, minimum-wage workers in the U.S. with kids in the continental U.S. get bribed to participate in the formal labor force. That is what raises after-tax income above various forms of federal assistance. Without that bribe, you see what we see in Puerto Rico, a much bigger informal sector because the rewards for participating in the formal sector are reduced. I do disagree on the emphasis that Ann has placed on the minimum wage. Ann rightly noted the discrepancy between what a low-skill worker earns in Puerto Rico and what a low-skill worker earns in the hotel industry in Mexico. But the relevant choice for a low-skill worker in Puerto Rico is whether or not to work in a hotel in San Juan or a hotel in Orlando. And I think that choice limits the extent to which wages in Puerto Rico can fall significantly below wages for comparable skilled work on the continental U.S. Second general point, debt sustainability. From a sovereign point of view, the most relevant standard, or there's a couple of variables that fall out of any standard analysis and that have a very significant impact on long-run sustainability. The first is the difference between the nominal or real interest rate. It's easier to do the math using the nominal interest rate and your nominal growth rate. If your nominal growth rate is roughly equal to your nominal interest rate, you will generally tend towards sustainability. If your nominal interest rate is well above your nominal growth rate, you will tend towards unsustainability. Puerto Rico's nominal interest rate across the bulk of its debt is on average 5%, a little bit less. Nominal growth, as Ann's report very usefully pointed out, has averaged about 1. And there's no realistic prospect, given that outmigration has accelerated, given that the current legislation hasn't adjusted the earned income tax credit and hasn't made it more attractive to work in Puerto Rico. I think we have to be realistic about the capacity to really move the nominal growth rate up in the near term, which implies that without some adjustments in the debt, there's a tendency towards unsustainability. The other relevant variable is the primary surplus, the amount of tax revenue that is collected prior relative to non-interest expenditure. Puerto Rico has made significant adjustments. They have increased the sales tax, and that's generating about $1 billion more in revenue. But even with that increase in revenues, a realistic estimate looking at across all the different tax-supported entities would suggest at best a small primary surplus right now. And I would caution that spending right now doesn't reflect full pension costs. So in my view, that stated primary surplus is actually probably not really there. Good news is there's not really a big primary deficit either, but you're a long way from the kind of sustained primary surpluses that can be the other path to debt sustainability. Puerto Rico's ongoing debt service, counting principal and interest, looking only at the tax-supported debt, so leaving out PRASA and PREPA, is about 5% of GNP. If you look at just interest, it's about 3.5% of GNP. The IMF, radicals that they are, has noted that 3.5% of GNP in an ongoing primary surplus is far too high for Greece, and I would posit it is also far too high for Puerto Rico. Municipal comparisons, taking the full gamut of tax-supported debt, looking at the full gamut of revenues, which includes a lot of things that are off budget, a lot of the debt service is off budget, but focusing only on those debts that are supported out of tax revenue. Debt service to revenue is about 30% of GNP. For a comparable sets of for high municipalities, states, you're not getting above 15. Illinois, I think about 10. So it's really significantly out of line. Puerto Rico's pensions have at this point no net assets. There's some lag data which suggests they have a little bit of money, but it's 2 years out of date. They don't have $3 billion of assets, and they got $3 billion of debt. In a couple of years, that $3 billion of assets is going to be completely gone. The pensions are effectively going to be pay-go. The notion of funding becomes irrelevant. All that really matters is the cash flow that is devoted to it out of the budget. There really is no comparison inside the municipal market to Puerto Rico. In order to fit within any municipal metric, Puerto Rico needs significantly less debt. I would note that Puerto Rico possibly could raise a little bit more income tax. I agree with that argument. But I would note that as a very poor part of the U.S., the amount that Puerto Rico will raise out of a progressive income tax is going to be low relative to the U.S., and this is not a panacea. Last point, if I still have time, is on the complexity of the debt. Within the tax-supported universe, which is about $50 billion of debt, I would compare that not to Puerto Rico's GDP, but to its GNP. Leave out the offshore pharmaceutical, which is kind of not really there from a tax point of view. They got about $70 billion. Revenues, counting everything, are a little over 10-ish. So it's challenging. But the real challenge is that $50 billion in debt is not homogeneous. Now, in the Greek case, the solution was keep the nominal value of the debt and turn the interest rate to as small a number as is possible. My understanding is that in the municipal market, because of the preference for tax-free yield, investors, broadly speaking, are more interested in reducing the debt to keep the coupon rather than in the Greek solution. Fair enough. The debts are trading at a deep discount, as John alluded to. So pick your number. Maybe their market cap is 25. If you could convert 25 into 50 into 25 yielding 5, Puerto Rico would be well within the realm of reasonable. The problem is deciding how to allocate that loss across Puerto Rico's complex debt stack, given that there are several groups of creditors that believe that they are, relatively speaking, senior, and relatively speaking, they should bear less of the burden or none of the burden. So one key challenge is how will general obligation bonds be treated relative to, and this gets really wonky, but the sales tax-backed senior bonds. Between those two pools, you have about half the 50, and those are the two with the strongest legal claim. So how are they treated relative to each other? And then how are they treated relative to all the other bits of debt? And then how will the various groups of bonds, which almost everyone believes to be junior, be treated relative to the seniors, but also relative to each other? What will the losses be on the COFINA junior bonds relative to the clawbackable bonds, the highway bonds? That matters not so much from the point of view of Puerto Rico and its long-term sustainability, but it matters a great deal to those individual funds that happen to be overweight highways relative to other pools. Where will the pension obligation bonds rank relative to the public financial corporation bonds? I mentioned this to go back to one of my earlier points, which is that the tools that the legislation creates are absolutely essential to managing a debt of this size and this complexity. And the unfortunate reality is that simply allowing every pool to vote on its own, given the number of pools, given the number of different bonds, is unlikely to generate a comprehensive solution. Now, it might, because of the threat provided by Title III and the more court-supervised process, and we should certainly hope it does. But that backstop of a court-supervised process is what is needed to ultimately assure a solution, given the complexity of this debt stock. Thank you.
Thanks, Pat. I seem to remember 7 or 8 months ago, you and I talking about exactly the need, which is now in the proposed legislation. And of course, we all know that in every crisis, the aggregate losses, which have already happened, economically speaking, and in market value, only take us to Chapter 2, which is who gets to eat which losses, as you so rightly said. Desmond.
Thank you very much, Alex. And what I want to say, just as the last speaker, is that I agree with a lot of what has been said before. I guess what differentiates me from Brad and Anne is that when I process this information, I come to a very much more gloomy conclusion as to where Puerto Rico is heading. And what I want to do is, perhaps at the risk of being repetitive, is just cover 4 points. First I want to just look at what is the starting point that Puerto Rico is beginning from, in terms of its growth area. Second, I want to look at the debt sustainability question that Brad has mentioned. Then I want to look at whether PROMESA does anything to promote growth. And finally, I just want to offer some ideas on the debt restructuring, where I guess I'd agree with Brad is that one's really going to need to have some sort of comprehensive approach. So just in terms of where Puerto Rico is starting from, you take a look at a chart like this, one has to be struck by the fact that, as Anne mentioned, beginning in 2005, you've had the economy slumping year after year, at the rate of something like 1% a year. You see that in terms of the GNP, that GNP now is down something like 10% over those 10 years. You contrast that with what's happening on the mainland. The mainland GDP's gone up by 10%. So this is really an extremely dismal economic performance. What concerns me most of all is the rapid rate at which the island is losing population to the mainland. So they've lost something like 10% of their population the last 10 years, and this is now accelerating. That, as Anne mentioned, they lost something like 2% of the population last year. They're losing even more this year. That is apparently running at a faster rate than 2%. So I'm not sure how you get prospects of this place turning around any time soon. As Anne mentioned as well, the labor participation numbers really are abysmal. That's the middle line, where you see something like a 40% participation ratio against something like 60% in the United States. So let me just talk a bit about the debt issue that, as has already been mentioned, the debt has just gone up progressively to $72 billion. If you take a look at the debt to GNP ratio, that's now 100%, and that's excluding the pensions. If you throw in the pensions, you're at 150%. So when I do the debt math on this, I come to a similar conclusion to Brad, that if you've got a debt stock that is around about 100% of GDP, if you've got interest rates that are around about 5%, if your economy is declining at around 1% a year, what it means is you need a primary budget surplus of between 4 and 5% of GDP just to stabilize the debt, not to bring it down, and that's excluding the pensions. This is just based on the 100%. Obviously, if you took 150%, you'd have a higher number. So essentially what Puerto Rico really has to do is it's got to get that primary surplus, it's got to generate the primary surplus, but it's also got to generate economic growth. And the reason for my pessimism is that I'm not sure that the two are compatible with Puerto Rico being part of a monetary union with the United States. So basically we've been through this drill before. We've seen what happened in Europe when you try to have very aggressive fiscal consolidation within a fixed exchange rate system. There's no offset to the budget tightening. So what you have is you have the economy going into a further slump. And I think that this is all the more relevant in the case of an economy that is already in a downward movement. So I like the idea of what PROMESA does, that I think that the idea of imposing on Puerto Rico a fiscal control board, you're certainly going to get more transparency, you're going to get better management, you can get better budget planning. What the PROMESA does as well that I like is the idea that there's going to be a stay on litigation, that if you don't have that stay on litigation, what you're going to have is a real court brawl between the different creditors and the island that I would think would deepen the economic recession. Having said that, on the positive side of PROMESA, what I don't see is how imposing fiscal austerity on this island without anything else is really going to improve the situation. I think that that would be counterproductive, deepens the recession, reduces the amount of taxes you're collecting, doesn't do much to the debt ratios. And I'd agree with Brad. I'd say that the same point, in terms of cutting the minimum wage, while I would agree with Anne that that is very desirable from a long-term point of view, from a long-term economic growth point of view, from the point of view of the immediate Puerto Rican economic situation, I would think that that would be another depressing factor. So this all leads me to believe that if you really are going to save Puerto Rico, you have to do a whole boatload of things, both from Puerto Rico's side as well as from the U.S. mainland side, in order to offset the deflationary, depressing kind of elements that would occur in that economy. So it's like the stuff that Anne has mentioned, improve regulatory environment, improve competitiveness, make it more business friendly, repeal the Jones Act. You'd have to do all of that, the Medicare, the investment credit. I think that all of that would happen. And you probably got to consider providing it with some sort of stimulus, from the mainland to replace those tax advantages that one denied Puerto Rico. Needless to say, I'm not sure that I see all of this happening. So I'm not sure that I see why Puerto Rico is not going to go the same way as West Virginia or Alabama, have population moving to where the jobs are, and just getting this island continuing along its path. The last thing that I would say is I would just agree with Brad on the debt restructuring side. I would have thought that what Puerto Rico needs is some kind of IMF approach to this, in the sense that I think the first thing that one's got to do is figure out how much budget adjustment can one reasonably expect from Puerto Rico? What is the maximum primary budget surplus that the island can produce? I would think it's certainly not 5%. It's probably something like 2%. Once you've done that, then you know what the amount of debt reduction that is required overall. Once you've got that figure, then you've got to determine what is the seniority of the different debt to allocate the losses. But I'm not sure that I get the logic of trying to do this in a voluntary way, not in a coordinated way. That I think that the different deals have to be consistent with the overall envelope. So I think there's a real agenda that Puerto Rico's got ahead of it. I'm just not too optimistic that this is achieved. I don't think that there's enough focus on what is the growth issue and how is fiscal policy consistent with getting Puerto Rico to move again. Thank you, Alex.
Thanks, Desmond, and thanks to all the panelists for really knowledgeable and pointed and relevant comments. I'd like to give each member of the panel, we'll just go down the table in the same order, 2 or maximum 3 minutes to add, if you want to add or react to what somebody else said, or just reiterate something, and give each person a chance to do that. So, Ann, we'll start with you again.
Thank you. I guess focus on 2 points. One, just to add something on the debt. There is a group in Puerto Rico, Puerto Rican Bondholders Association, that is insisting that, of course, the debt should be paid. There shouldn't be any restructuring. I've read their stuff, and my problem with it is simply that Puerto Ricans can't pay the debt. You can't get blood out of a turnip. And what they expect to happen, and my own argument would be that if indeed there is no satisfactory restructuring, although we can worry about what satisfactory is, but if there isn't one, the amount the bondholders will get is even less. Because obviously there isn't going to be any resumption of growth, no matter if all the things Desmond and I and Brad and John would like happen. Without something on the debt, nothing else is going to happen. So I think that that's critical, and I don't think it can be emphasized enough. All of this fuss about that, I think, sort of Puerto Rico has another 5 years of stagnation. Quite clearly, the present value of the debt will be even less than it is now as a percentage of face value. But I want to turn to the minimum wage for a minute, because Desmond referred to the falling wage bill and so on. It seems to me that when you have a cut in the minimum wage by law, it does not mean that everybody gets their wages cut, first off. Secondly, it is not true that everybody in Puerto Rico goes to the mainland. Unfortunately, some of them go into the informal economy. Some of them sweep their uncle's store and things like that. Getting them into jobs where, indeed, within 4 or 5 years, the prospects are that they could become more productive and get some training are important. Right now, there's no training going on as far as we could learn in almost any enterprise in Puerto Rico. And by the way, one of the places that training is a little bit important is in the entire hospitality industry. A lot of 6-month courses and things like that are given to the lower paid workers on the mainland. And I checked just because I was there in Fort Myers recently, and a normal employee will get 3 months of training as he starts on his minimum wage type work, and he will go up the line. It doesn't stay there. But when you, in fact, you have no ability to do that kind of thing because you can't keep the. By the way, in Puerto Rico, the law is you can't fire anybody after they've been with you for 3 months, so you can't even have a trial period that makes much sense. And I could go on. The constriction on the labor market is important, and a number of countries have had a huge boom in employment once they have relaxed their labor market. I think Chile is perhaps the most prominent example, where indeed they did remove most of their restrictions, including especially letting employers have the ability to fire. Take away job tenure forever. It made a big difference. And the thing that makes me worry about this is if we say we can't do it now because it won't have that much effect the first year, and I would certainly agree it's not the panacea the first year, but if we don't start it now, when do we start it? And we do agree it would take several years to take hold. I think that's important. I would also cite Germany, where their structural reforms were in the labor market in 2003, 2004. Everybody said these were terribly bad, they would be depressing and so on. And Germany's performance since has been better. Labor market reforms are always thought to do the bad. They don't necessarily do so. And as I said, if you do it in the way it's proposed in Promesa, it's very likely that some folks young men who would otherwise either go into the informal economy or remain unemployed would start some employment. Some of those surely would be able to become more productive. And many people do prefer to stay on the mainland. All kinds of people, even just taxi drivers and so on, were telling us about a son or daughter or son who'd gone to the mainland. They were hoping they could find a way to bring them home. The son or daughter didn't want to stay there, but they couldn't earn anything in Puerto Rico. They couldn't find a job. So I'm not so as convinced as Desmond is that this would necessarily be depressive in the short run, because I don't think you'd cut the wage of everybody already working. You would simply have for a while, 2-tier system where you had entry-level jobs at a lower wage than the ones that already exist.
Thanks. And John, some more comments?
Sure. Yeah, I would just like to highlight, first of all, future market access for Puerto Rico would certainly be feasible, and the municipal bond market can be helpful to a recovery, although a lot of work has yet to be done to get to that stage. Couple of examples. Many of the recent highest profile bankruptcy cities or facilities over the last 5 years have actually tapped into the municipal bond market, including Jefferson County, Alabama, as you can see up here, priced 1.78 billion in bonds with a spread to AAA of 116 basis points. At the time, that was a 5.3 to a 5.65% yield. I think importantly, they did earn, at least by one rating agency, by S&P, a BBB rating. So an investment grade rating, and today the AAA municipal bond yield average at the long end of the yield curve is actually the lowest that has been since they started keeping that record in 1981. It's at 2.34%. So even 200 basis points above the AAA would be 4.34%. That would be a pretty attractive market access point, I think, for a borrower like Puerto Rico. Now, again, that does imply earning a BBB rating, but specific securities in Detroit, Michigan, as is not Detroit GO, but a utility tax-based security has been issued out of Detroit, Michigan at a spread of 125 basis points over the AAA. Stockton, California, another bankrupt city, has issued water and wastewater revenue bonds. For a couple examples of post-bankruptcy, post-restructuring access to the municipal market at credit spreads tighter than 200 basis points. And again, 200 basis points now would represent only a 4.34% yield. So that is feasible. I would also comment, the municipal bond market is large. It's 3.7 trillion. Over 90% of it, though, is investment grade. So high yield, which is where they would be today, even post-restructuring, they would probably be in the high yield category today. That is a little bit, that is certainly more of a niche, harder to bring large deals at reasonable prices or affordable yields for an issuer like Puerto Rico. The high yield municipal peer group in total is approximately 80 billion. Nuveen is about 20 of the 80 billion, so over 20% share of that. So it is a little bit more nichey. It is a little bit more constrained. The largest high yield deal ever was the financing of World Trade Center number 3. That's 1.5 billion. So that is also a feasible access point for some amount of bonds, but for something in the scale of Puerto Rico of 70 billion, or even if it's haircut to say 30, 40, 50 billion, you're going to want to try to earn an investment grade rating. Earning an investment grade rating, a lot of work has to be done, including better disclosure, including balanced budgets without deficit financing, including some kind of clarity on the pension and a pension funding that makes sense, again, within investment grade criteria. So a laundry list of things to achieve that investment grade rating, but demand for municipal bonds, even in the BBB category at relatively low yields, is definitely there.
Nice, John. That's a really important point. Thank you. Brad.
So I thought I would take up two of the points that Desmond raised. The first is whether voluntary agreements can work without coordination. And then the second is how to avoid a euro area style downward spiral whereby fiscal consolidation leads to a loss of output, which leads to a loss of revenue, which leads to more fiscal consolidation without ever allowing a real return to growth. Which
leads to more losses for the creditors.
That's also true. And I think Desmond and I agree that unfortunately, broadly speaking, is a fair description of what has happened in Greece, and we should aim to do significantly better. So the first point is, how can voluntary agreements potentially work? And I think the answer to that is that the legislation provides a framework for coordinating those agreements, because they all have to be approved by the oversight board. And the oversight board is playing a very central role in the restructuring process, not just in the budget process, because any such agreement does need their approval. And any agreement in the more court-supervised, formal restructuring process that will follow also needs their approval. And if the oversight board is going to do its job, it will need to undertake, at least in my view, the kind of debt sustainability analysis that would allow it to have a vision of what is overall sustainable and make sure that any individual agreement with any subgroup of creditors is consistent with that overall vision. If that doesn't happen, then I do think there is a risk of an uncoordinated outcome that doesn't in the end achieve sustainability, which only assures a future restructuring and makes it almost impossible to return to the municipal bond market. How can a cycle of austerity begatting more austerity, begatting less growth, and so on be avoided? I actually do consistently come back to the earned income tax credit because the amount of federal support that could be provided to Puerto Ricans to offset the impact of what certainly will be in aggregate some additional fiscal consolidation through equalizing the treatment that low-income Puerto Ricans receive with low-income workers on the mainland is significant. It's ballpark 1% of GNP. That means it costs money. But it does provide a mechanism for limiting some of these negative feedback loops. I think there is a bigger, more philosophical question about how we should handle those parts of America which aren't doing well, and whether they should, in some sense, receive a significantly better deal than from the federal government than those parts of America that are doing well. But in Puerto Rico, we don't even have to really make that choice. There is still room to give Puerto Ricans and low-income Puerto Ricans the same deal in Puerto Rico that they get on the mainland. And it seems to me that is the minimum we should aspire to allow Puerto Ricans to choose themselves without having to worry about whether they're not going to have Medicaid benefits, without having to give up the several $1,000s a year that you receive from the earned income tax credit if you're making $20,000 and have a kid. Those kinds of choices should not be made for Puerto Ricans because of a discrepancy in how they're treated by the federal government. Puerto Ricans should receive the same basic bargain, whether they choose to pursue their life in San Juan, New York City, Ohio, Florida. And then hopefully that will provide the basis for a better future.
Thanks. Desmond.
Yep. I'll just make a couple of points. I very much agree with Anne that, having some sort of orderly process is going to be not only in Puerto Rico's interest, but also in the creditor's interest. But I would add that, I think very much one often sees bandied about the moral hazard argument, why, Puerto Rico shouldn't be helped, because this might set a bad example to other states, for irresponsible behavior. I would use that same kind of argument to say this is the reason why the creditors should be bailed in, that there's a moral hazard argument here that we don't want to encourage irresponsible lending. Puerto Rico could not have got to its present position without being facilitated by easy money coming from abroad. Just on the question of the wages and the fiscal austerity, I just think that if you've got that combination going in, that does run the risk of deepening the recession. But I'd agree with Brad that if you accompanied it with a whole bunch of other things like the Medicaid or the investment tax credit, getting some kind of support from Congress in other areas, there might be hope. But I would think that if you just do what is in PROMESA, we really aren't going to get growth there. The last point that I'll just make in relation to John, when he talks about Puerto Rico reaccessing the markets and looking at current conditions, I just wonder whether we don't right now have the most favorable conditions that we've had for a long period of time. and that this might be that there's a huge risk on trade right now, but should the global economy turn out the way that I think it's going to turn out, with problems in Brazil, with problems in China, with problems in Europe, with a little incident in Puerto Rico, I'm not sure how markets, that these kind of prices might, in hindsight, look to be the golden age of these bond markets.
You can comment on that, John, if you want. Is this the golden age of the municipal bond market?
Well, I mean, this it is. There's no question that the municipal bond market as a whole is being buoyed by a number of different factors. I mean, first of all, the tax benefits cannot be ignored. It's the only game in town for upper income individuals for taxes. In addition, the global bond markets are being boosted by a massive amount of purchasing from the Japanese central bank, as well as the European Central Bank, which announces starting to buy corporate bonds as well. Over 10 trillion in global bonds trading at negative yields. Even at record low municipal yields, roughly speaking, around 3%. That on a tax-exempt basis, again, it's low yielding relative to history, but it is actually high yielding relative to the rest of the world, and there doesn't seem to be a near-term turnaround in the demand, and there's no near-term turnaround in the policy of global banks pushing these rates either towards zero or in some cases to negative rates. I would just say investors are making credit differentiations. Obviously, Puerto Rico is not participating in that rally because it's people are trying to figure out what kind of principal they're going to get back. But for either creditworthy or even BBB or BB type securities, those are participating in this global demand for bonds.
Thanks, John. Ann has a comment on the fiscal issues.
Yeah, I guess I'm less persuaded than Brad and Desmond on the fiscal thing, and I just wanted to make the point clear. First off, Greece has had a very unusual history in that, they have not carried out their commitments. They've dragged their feet every step of the way. One estimate I saw was that Greece had even started only on 68% of the commitments it made under its first program way back when. Portugal's comparable number is 93%. Greece is just way off the charts in terms of its dragging its feet and so on. The process has been prolonged at least as much, if not more, on that score than fiscal adjustment. If you compare Greece and Iceland, which I just did for another purpose, the interesting thing is that their fiscal adjustment was about the same. Interestingly, Iceland bottomed out in, I think, the first quarter, but it might be the second quarter of 2010, and is above its level of income of 2008 when the crisis hit by 2015. You can see the recovery. It's quite quick, and it's quite clear that what had to happen happened, and it happened quickly. But there are many others. Latvia had a crisis. We talk about Greece and how terrible it is, fixed income and all that. The Lats cut their nominal wages, their nominal GDP, and everything else enough to get back to reality, and I think the total cut was over 20% nominal, and without much of a recession along the way. Turkey, in 2001, total fiscal deficit of 20% of GDP, primary surplus, of course, even deficit, almost that. 2 years later, 6.5% primary surplus, and guess what? Their growth in Europe, the rest of that decade, was higher than any other country. And yet this was fiscal consolidation, but it happened quickly. And the argument against fiscal consolidation quickly seems to be a difficult one, because you've got to convince yourself that things aren't going to just get into that downward spiral, whereas quick seems to do it all the time. I could name other countries. Ireland is another one that's done it relatively quickly and gone at it. And it seems to me that when you do have a big adjustment to make, better to get it behind you, create expectations that things will go forward, rather than saying, oh boy, if we do this, that, or the other, it's going to get worse. Yes, there can be, Chile is another case in point. There are just so many of them. I really couldn't argue that they will all work, because so much else depends on so much else. But on the other hand, it is not clear in Puerto Rico's situation that doing something on the wage would hurt it.
Thanks, Ed. These are good balance to remember. And if all that's true, Puerto Rico will be back with Jefferson County in no time in the bond market.
Not unless they adopt the reforms they should. That's the problem.
Let's take quick comments from Desmond and Brad, and then in a couple of minutes we're going to get to your questions, ladies and gentlemen.
No, I would agree very much with Anne that Iceland is a success story, but what I would do is I'd point out that Iceland just happened to have a massive devaluation of its currency and a floating exchange rate, which helped. Latvia that Anne mentioned had, I looked at the numbers in terms of loss of output and in terms of outward immigration. Latvia is only after Greece. Greece is worse than Latvia, but Latvia comes second in terms of the countries that have had the steepest decline in output in the post-war period. So I'd say that was another example of a fixed exchange rate. And if you look at Europe just generally, one has to be struck that Europe has only now regained its 2008 level of output, and countries like Spain and Italy are something still 7% below where it was before. So, the notion of doing fiscal austerity in a fixed exchange rate system is not without its downside risk.
Brad?
Greece may not have delivered on all of its structural reforms, but one reform that it did deliver on was massive cuts in nominal wages. So if you look at wages in Greece, they are down quite significantly.
All right. We are going to get to audience questions, but I have a question first. We've all talked to some degree about pensions, and the Puerto Rican unfunded government obligations on pensions are, as has been pointed out, a very large number relative to the debt. Another 44 or 5 or 6 billion on top of the 71 or 2 billion. And Brad, I think, rightly pointed out there are really no assets in that plan. These are totally 100% unfunded pension obligations. So, do we have a proposal or any comments on specifically with respect to the Puerto Rican government employee pension problems? What should be done, and then after that, John, more generally, how about government pensions in the municipal bond market as a ever more important credit factor? Maybe, if anybody has a comment on Puerto Rico in particular.
I can speak to some of it, but not all of it. The interesting thing is that they figured out about 10 years ago, I think it was about 10, that they had a problem in their pension fund, so they switched from defined contribution to defined benefit. The trouble is that they've been using the money that came in on defined benefit to fund the defined contribution to fund the benefits so far, which is why they have no money. So by law, they have to do it on the basis of what's in the fund, but there's nothing there, which makes it a legal problem, apparently, as well as a constitutional problem for Puerto Rico, as well as a fiscal problem for all of us. It seems to me inevitable that there will have to be some kind of reduction or smoothing out or something, possibly combined with some other measures to soften the blow. How to do it, I have not seen a proposal other than that simply there's going to have to be some cut, and it's not entirely clear. You go in. Now, there are things you can do pretty quickly. One of the numbers we got was that while the number of students in the Puerto Rican public schools, secondary and grammar school, had gone down 30% since 1980, I believe was the number of teachers has gone up 40%. Quite clearly, there's a flow problem and a stock problem, and something you could do already would be to cut down the number of teachers, which would cut your budget there, which would give you something more for it. And that's one we did include in our report, but there are other measures like that that would also help. There's a lot of waste in the Puerto Rican government's measures.
In the city of Detroit, as I remember the numbers, the general employees, not the police and fire, but the general city employees, got the equivalent of 83 cents on the dollar, I think it was, on their pension plan. So that's a significant and important precedent in dealing with unpayable pensions. Desmond, you had a comment on Puerto Rico?
Well, I would just think that your point about pensions is just another case of how the losses are going to have to be allocated. And they're going to be part of the process. But I think that that's another reason why this whole debt restructuring has to be done in a very coordinated way, and that I don't see how you can do it in a voluntary way with one bond class after another. That the whole thing's got to be done with a vision as to how you're going to be sharing the losses and what the seniority is between the different claimants.
John, comment on Brett on Puerto Rico? Yeah, please.
So I would make a couple of additional observations that reinforce some of the points that Desmond has made. There are two significant pension systems in Puerto Rico, the employers and the teachers. The employers has already been reformed, and at least in my judgment, the future benefits promised under the defined contribution plan are not extraordinarily generous. And I think there is a real question of equity, if you just view it as all one liability, between those people who have liabilities that have already been reduced as a result of one reform and those who have unreformed liabilities. So I hesitate in that sense to just say 83 cents on a dollar without looking at the path that got the initial dollar. The second observation is that we kind of know, thanks to Anne's very good work, the basic parameters of the problem, which is that on that ballpark, pension payments going forward are about 3% of GNP. Ballpark existing contributions are maybe 2% of GNP. So you kind of got a 1% of GNP gap, and that gap has to be filled one way or another. My personal view is that if you look at it in those terms, it is pretty clear to me, at least, that you are not going to be able to generate enormous savings out of the pension system to deliver significantly better returns to the bonds than they now anticipate. But other people will maybe come to a different conclusion.
Thanks. John, how about one comment in general about the municipal bond market and the role of unfunded pension debt?
Sure. Now, tough to summarize unfunded pensions for municipals as a whole, but there are thousands of pension plans out there. A couple of comments. So far, it's been really more a matter of downgrade risk as opposed to default risk for the municipal sector in terms of unfunded pensions, creating downgrades in Illinois, creating downgrades in Chicago. Overall, pension funding ratios have been stable to just slightly increasing. The average state is around 74% funded. Of course, that relates to discount rates. Discount rates still range from 6 to 8%. 8% is looking, probably a little high on a going forward basis, although investment returns in these funds have been pretty good. Forward-looking returns, if you switch them more to fixed income and look at where interest rates are, 8% looks high. There have been some revisions to lower those rates. Of course, as you lower those rates, your present value of your liabilities goes up, and there is some of that going on currently as well that could make pension funding ratios look a little bit worse, but also a little bit more conservative. The Moody's has been through their reviews of GOs broadly and done a lot of downgrades already, cycled through credits with significantly unfunded pensions. For their part, the states, almost every state, not Illinois, of course, but most every state has made some adjustments since 2008 in terms of there have been a lot of changes to their plans. There have been changes to retirement ages. There have been changes to COLA benefits. There's been conversions to hybrid / 401ks. There have been a lot of changes to new employees being hired in on a 401k instead of a pension, but you still have to take care of those people who have accrued pensions up to this date. So I think it's mostly a matter of potential ratings changes in the municipal sector, mostly, not necessarily any one pension fund causing a default on municipal debt in the United States, but Chicago being the biggest center of risk for addressing their roughly 30 to 40% funded ratio. They have to address that over the course of the next 10 years. So nothing like a Puerto Rico where they're effectively out of assets. If Chicago did nothing, their fund would projected to be lasting about 10 years. So there is still some time to make adjustments even in Chicago.
Thank you. Now, ladies and gentlemen, we're going to come to your questions. May I remind you of AEI rules here. Please wait for the microphone to arrive. When it does, tell us your name and your affiliation. Ask your question. If your question is preceded by a lengthy comment, if that comment exceeds 1 minute, you'll be reminded by the chair that it's time to ask the question. I'm going to start right over here, please, and then we'll come to this way. Yes, right here, please.
Thank you very much. I have so many questions. I'm just trying
You
to
only
narrow
get
it down
one,
to
but,
one.
but our first question is you need to let us know your name and your affiliation, please.
Sure. My name is Jonathan Trichter. I'm affiliated with the Mava Group. We're a restructuring boutique, and we do some municipal restructuring as well as corporate restructuring. So if I have only one question, I guess my question is just to help me understand better some of the claims of inequity when you talk about the Medicaid match in Puerto Rico. My rudimentary look and understanding of this was that it was lower than other poor states simply because Puerto Rico didn't pay federal income taxes, right? So there wasn't the outflow of cash to the mainland, and so the Medicaid match was less than it might have been where Puerto Rico was state. And yet the cries of inequity over the Medicaid match are so loud from Puerto Rican officials that I think maybe I'm missing something, or maybe they're missing something, but I'm curious about the history and how to think about that in that context. So narrowing down my questions to one, that's my question.
Thanks very much. I think that's a question for you, Brad. That is an important point you bring out, that Puerto Rican citizens are not paying U.S. federal taxes, as we haven't mentioned, and is clearly part of the whole puzzle. But Brad, how about the Medicare issue?
So if you want to say that Puerto Rico does receive some medical support now, even though it doesn't pay federal income tax, I mean, it's fundamentally a policy choice. The observation that I made, I think it has the low level dates back, is my understanding, to an agreement which capped funding in return for Puerto Rico having its own unique system. But the net effect of this over time has been that the amount that Puerto Rico receives from Medicaid for poor citizens is much lower than a state. And set whatever you think about whether Puerto Rico should or shouldn't pay federal income tax, on a pure fiscal basis, as Ann noted, once the Affordable Care Act, which is a one-off grant money, runs out in a couple of years, will be about a $1.5 billion at least gap that opens up between current levels of medical benefits, which are mostly paid through this one-off grant, and the amount of funding that Puerto Rico will have, which will either imply draconian cuts in Medicaid or medical care funded out of the Affordable Care Act, so for poor and lower income, or a big fiscal adjustment, which means less money for somewhere else. So in some sense, from a fiscal point of view, history doesn't matter. Whether Puerto Rico pays federal income tax doesn't matter. What matters is that there is a significant portion of medical care provided to low-income Puerto Ricans that is now financed through a one-off grant from the Affordable Care Act. That money will run out. There will either be more money provided to Puerto Rico, more money coming out of the budget for medical care, or an enormous reduction in medical care provision. It's a fairly direct choice.
Thank you, Ann.
Two small points. One, I do not know how we calculated, but I know that my co-authors did calculate what Puerto Rico would receive under the federal formula if it were treated like Mississippi as a state. Now, what they did about income tax, I don't know, but the answer was they were getting half what Mississippi would get, and I presume they took that into account, but can't say so. The second thing I do know, however, is that University of Puerto Rico has a pretty good medical school. They subsidize it like mad. They produce a large number of relatively well-qualified physicians, and almost all of whom go and work on the mainland. Cutting that subsidy would be another area. I mean, there are lots of these areas where it isn't a huge amount one by one, but you add them up and they're huge. And in the case of Puerto Rico, the subsidy on medical education is huge.
Thank you. I have a question from this younger gentleman, sort of in the middle of the room here, please. Wait for the microphone. I know this is your first time, so you don't know the rules.
Bert Ely, a banking consultant, and as always, thank you for acknowledging my youth. In listening to the conversation today, I didn't hear anything about the extent to which there's entrepreneurial activity in Puerto Rico, and be interested in any thoughts you might have on that, because it seems to me that one of the indicators of economic health of any area is the extent to which people are willing to start businesses there. But I have a question that, more basic than that, and that is, in talking about various steps that need to be made to improve the competitiveness of Puerto Rico and therefore its long-term sustainability, are we really having an aggressive enough discussion? I didn't hear anything about the problem of high energy costs, maybe the need to privatize PREPA, and to take even more radical steps like getting rid of the minimum wage altogether rather than just adjusting it at the entry level. To put it another way, and I'll wrap it my question this way: are the proposals for Puerto Rico really being aggressive enough, given where it is today, to establish long-term sustainability and competitiveness, or are we just kind of really tinkering around the edges and just kicking the can down the road?
Okay, are we aggressive enough? And how about entrepreneurship on Puerto Rico? Ann, you have a comment?
Well, obviously, if I had my way, they'd do more, especially on the growth front, which is the one, and a lot of the more would be the U.S. government, and more of it would be Puerto Rico. Neither one seems to be facing up to what they could do to get a much quicker response on the part of the economy. But I live, I suppose, in the hope, perhaps forlorn, like Desmond, that if indeed there were enough change under the promesa, that would give a little bit of boost, and that you might then get a cumulative cycle, and they might at that point undertake some of the other measures they might take. And that has been known in some political jurisdictions, mostly countries, to happen, but it's not the most likely outcome, I don't believe. So I would share your view that I would like to see much more of a, quote, shock therapy right away, in the sense I think it would have a better chance of stimulating growth again. Entrepreneurial activity is moderately weak from everything we could learn. There's statistics, as I told you, are terrible. But there is, as I said, this development office which does receive foreigners, not domestic citizens, and offer them tax breaks. But those, of course, are normally bigger ventures anyway, so it's hard to say what's happening. Obviously, there are lots of little activities. I don't believe I heard of anyone who had started out small and gotten big. And some of the things that had been going on with domestic entrepreneurs had indeed been hurt enough by the recession that they'd gone bankrupt. So that's all I can tell you.
Anybody else? Okay, I had a question. Oh, excuse me? Go ahead.
I would just,
Then we'll come to your question.
I just mentioned, to Bert's question about restoring competitiveness. Here you've got a problem that is similar to that in Europe, in that if you've got to restore competitiveness within a fixed exchange rate system, what it necessarily means is your price level has to go to a lower level, that you can't do it through the exchange rate. You've got to get your prices down. This is what people refer to as an internal devaluation. Now, that is all well and good if you don't have a lot of debt. But if you do have a lot of debt and you're going to get competitiveness restored through deflation, what that does is you might solve one problem, but then you're aggravating your debt problem.
Over here, please.
Thank you. My name is Max Trujillo, and I work for the firm of Tonio Burgos and Associates, a government affairs firm. It seems that the understanding is that the debt has to be managed, but there seems to be concern of whether or not the voluntary process is going to be a viable process to go forth. One of the reasons why people are for or against this bill is precisely the restructuring authority that the control board may exercise. I wanted to ask the panel, do you really think that the bill would actually allow a restructuring process to go forth, considering the different triggers it has before the control board can actually exercise that, and the number of people it requires for it to go then to court to evaluate that restructuring. Because at the end of the day, the control board is not going to determine the judicial part of this. It will be a federal court. But they have to vote 5 out of the 7. Considering that this is a political process, who do you think are really going to be the candidates from those positions? Thank you.
Thank you. Good question. Okay, is it really going to work as laid out in the legislation? John?
Well, I think the foremost goal is to get negotiated compromise and probably a bond exchange. And some of the negotiations will hinge around what the new bond looks like. There could be an opportunity for simplification. First of all, with 18 different indentures, maybe you could have one well-secured bond in the future. And then dealing with those 18 different indentures, you can establish different exchange ratios in terms of what percentage you get back of this new bond. With the new bond, the control board could set debt service payment capability that people have confidence in at a certain coupon and a certain total par value, and then the exchange ratios could be used for how much of that new bond do you get for GOs versus COFINA seniors versus COFINA subs and that kind of thing. So the question is, what's your incentive to actually turn in your old bonds for the new bond? And I think the incentive to turn in your old bonds for a percentage of the new bond is that if you don't, you end up in court. And ending up in court could be more expensive, and you could get a lower return. So I think that's kind of that's the process, both sort of a carrot and a potential stick at the end if negotiations don't actually happen. So I think structurally it gives you the best opportunity to have a negotiated process without litigation.
Go ahead, please. Yes.
So if I had my druthers, the vote to enter into restructuring authority would have been taken by a simple majority rather than a supermajority. I think that would have been a cleaner outcome. But this is a bipartisan negotiation. That was the bipartisan compromise. And I think given that there's been a surprising amount of bipartisan cooperation up to this date, I'm going to trust that the oversight board will continue to work in a bipartisan way. And so therefore, I am confident that if this is necessary and there isn't an agreement into an exchange that delivers sustainability during the period for negotiation, which is fair, that the oversight board will do the right thing and allow the restructuring authority process to go forward.
Thank you. More questions? I have one in the very back here.
Michael
Hi,
Barone,
Michael.
Michael Barone with AEI and the Washington Examiner. Question. If markets are so smart, why do people buy all this Puerto Rico debt?
I think that one's for you, John.
Let's see. I mean, this is it's a good question. I mean, this is a historical situation in that Puerto Rico has had an investment grade, had previously to say early 2014, had investment grade ratings. They even had an upgrade on the GO to A- in 2011 or 2012. They had investment grade ratings, a higher yield than other BBB rated bonds, as well as a tax exemption not only federally but also in every state. So in some sense, the structure of Puerto Rico's tax exemption made it as a sort of a backfill when certain states were in scarcity mode. So if Maryland isn't issuing any paper, if Virginia or California or New York are very scarce in terms of their paper, and some of these states have many, many wealthy individuals paying additional tax of upwards of 10% on top of their federal tax, and Puerto Rico looks cheap, and it has either a dedicated sales tax in the case of COFINA, or it has some constitutional language around debt service repayment in the case of GOs. That created a fairly liquid market for the paper. The decline in the economy has been ongoing over the last 10 years, and it's been covered up by additional issuance effectively. and the additional issuance with each new issue got tougher and tougher to place. Prepo was a very difficult issue to place, even with the 7% coupon in the summer of 2013. And then the GOs were also a difficult issue to place with an 8% coupon and 93 cents on the dollar in the mid 2014. So with each subsequent issue, it got cheaper and more difficult because of the fundamental deterioration. So it is. I mean, you can see what the incentives were to buy the bonds over many years, and it's been a 10-year decline for the market to kind of figure out that they've reached a point where they can't pay everything back.
Michael, I'm going to give you a chance, but I just have to tell a story. Michael, our AEI colleague Adam Larrick, who has worked on many sovereign debt restructurings, loves to tell the story of the bondholder who stood up in the bondholders' meeting and said, "Well, if I knew I was going to have a loss, I never would have bought it." Desmond.
Yeah, I just wanted to tell Michael a story that puts him in very good company. Professor Merton, when he came from, I think it was either MIT or Harvard, to work at Solomon Brothers for a while. Professor Merton is of Black-Scholes fame. They asked him after 6 months working at Solomon Brothers in New York, had he learned anything? And he replied that what he had learned was that the markets looked a lot better from the Charles River than they did from the Hudson. So you're in good company.
There's another story, because after the 2008 crisis, Queen Elizabeth was meeting with some of the people at the Bank of England and wanted to know how all these smart people could make such a stupid mistake.
Don't think she ever got a good answer in. We have time. Last question here.
My name is Li Yang. I think the deficit of debt usually is because of something abuse or careless or mismanagement. So I wonder if you can, based on concept of household management, that you have to maintain the balance at least, so you can have a real productivity and you maintain your assets, resources. You can have a business, and then you can produce the taxation and revenue for the government. So is there anything, maybe partisan compromise, maybe that's not a good way of management, and a threat to the courthouse lawsuit is not a good management. So I just wonder if there's anything fraudulent transaction that divert government resources to benefit a few and then go into the bigger debt.
Okay, thanks very much. Let's take that question. Is there some element of fraud or corruption in all this? We haven't talked about that needs to be thought of.
Of course, there will be some element of fraud and corruption. I think the bigger problems are a history of not fully accounting for all expenditure in the budget, a history of pushing debt service off the budget, a history of overestimating how much tax revenue will be provided, a history of providing tax breaks and tax concessions without fully assessing their long-run impact on the budget. And all of them, are reasons why the Oversight Board is an essential part of the compromise legislation.
Thank you. And thanks to all our panel for really outstanding presentations and comments. And thank you all for coming.